Hello and welcome. My name is Simon French and I'm Chief Economist at Panmure Gordon. Today we're going to take a look at the prospects for the UK and European economies heading into the final 5 months of the year. What you have is European equities particularly underperforming their US counterparts since the COVID outbreak. And indeed, the rebound has been heavily led by the tech sector, in which Europe is underweight compared to the US benchmark. And there is also concerns that underlying trend growth is still impaired despite the recent enthusiasm for the fiscal bailout package in Europe. Closer to the UK is ongoing concerns which have really stifled international investor appetite for UK assets since the Brexit vote in June 2016. In the second half of the year, the latter point, the Brexit negotiations, will start to get down into the business end. In October, we are likely to see the heads of government rather than the negotiating teams come together. And we found in bilateral discussions between the US and China, between the UK and the EU, that it actually takes political leadership to make the kind of concessions that will be required to get a deal over the line. For those concerned about the frictions to EU-UK and UK-EU trade, then it's unlikely that the deal will remove those frictions, but certainly from the standpoint of understanding how big or how small they are, then the colour of the deal will allow investors to narrow that spread. And it is that narrowing that is probably the most compelling reason for UK assets that remain underloved versus global benchmarks to see some return in the fourth quarter of the year. I think investors can afford to be patient. There's probably likely to be negotiating teams falling out sooner and then a concession made later in the year. But both UK equities and sterling, in terms of the potential upside on the two cross rates against the US dollar and the euro, we think there's significant opportunity there, and we see about a 10% upside on both of the two currency cross rates, and potential closing of some of the 20% upside between the par value of UK equities and global equities. Going back to mainland Europe, a lot of the economic trajectory which will drive appetite for risk assets will hinge on whether emergent signs in the last few weeks of a second wave of infections translates into something much larger than we've seen to date, and indeed translate into an increase in death rates and a greater public appetite to have a secondary lockdown, which will stifle activity. Our view is that while a vaccine should not be, or the timing for a vaccine should not be in any investor's horizon, it's almost impossible to know with any certainty what point a vaccine will come along. We do know that treatment, prevention, and the capability to test and trace has improved across every geography, and therefore the tolerance level of COVID-19 compared to in Q1 should now have increased. There can be more infection in the community, and that can be managed. And that, in terms of our base case, should mean that localized lockdowns across Europe will be the strategy that will prevail in the second half of the year, rather than holistic, cross-country, cross-regional lockdowns, which we saw earlier in the year. So actually a recovery in European corporate earnings, probably a significant double-digit recovery, should start to come through and support a modest re-rating later on in the year, and against the backdrop of ongoing very accommodative monetary and fiscal policy, money supply increasing more than 11% year on year in the Eurozone. That's a compelling case to see some upside to European risk assets.